What's up everyone, Alex here. Investing is all around making a long-term gain, and there has never been a more exciting time to be an investor. Over the past year, we've seen the pandemic ravage global stock markets only to see them roar back to record levels. In the meantime, investors have been able to make more and more money, and it has also attracted a record amount of retail investors investing in the stock market. With apps and fractional investing, it has never been easier, and retail investors are scrummaging in order to find the next big investment that will make them a millionaire, whether it's Bitcoin, cryptocurrencies, or meme stocks such as AMC. So today, and as always, I'm not a financial advisor, but this is my view. I'm going to share with you the 3 stocks that I plan to invest in order to make long-term gains, and I'm going to talk about those with a substantiated manner, but I'm also going to talk about key investment principles such as stock market rotations and what a value, an income, and a growth stock is. So if that sounds useful, keep watching. And as always, as I'm starting out my YouTube channel, it would be great if you can hit that like and subscribe button. So as we get into this, I'd like to take a little bit of a step back to talk about a couple of interesting concepts and things that have happened over the past 15 to 18 months. We have 3 types of stocks, generally speaking. We have income stocks, we have growth stocks, and we have value stocks. Growth stocks are companies such as Amazon, which grow tremendously over time and grow exponentially, and we want to buy them because they are growing. Sometimes they might not be making a profit, or they might have what we call a very high PE ratio, but we're willing to buy into them because these companies have a very good business that is growing over time. The second element is what we call value stocks, which means that for whatever reason, at that given point in time, whether it's public perception or news, we anticipate that those stocks are relatively undervalued to their intrinsic value. A good example is what happened during the beginning of the pandemic. All of the airline stocks, all of the hotel stocks dropped tremendously. Now, it doesn't mean that at that particular point in time, those businesses didn't have challenges, but when we look at the broader picture, when the economy reopens, those stocks are potentially undervalued, and therefore we call them value stocks. The third element of stocks is income stocks, and these are stocks which represent established, very stable business, but they pay usually a high dividend in order to compensate investors, right? Because if a company isn't growing tremendously, the stock price won't particularly grow, and if a company isn't potentially undervalued, again, there's no reason for it to grow. So if it's a very solid company that is stable, what companies often do is give investors dividends in order to pay back money. Now, a great example of that is oil companies such as BP and Shell that traditionally had very high dividends. Now, I know, don't shoot me, oil stocks have dropped tremendously because of the pandemic, but we will talk about that a bit later on. Now, what has actually happened? If we look at the S&P 500, we see that it plummeted with the start of the pandemic, only to now bounce back and steadily go to record levels. Now, in previous videos, I've often talked about the importance of dollar cost averaging and investing in index funds, because over time that is the best way to build long-term wealth, and we've seen that happen in practice. Although there was a short-term drop, markets bounced back very quickly, so if you kept buying the index fund, you would have benefited from the drop and kept buying as things go back up. What has happened in individual stocks is very different to what's happened to the index. So when the pandemic took place, everyone started investing in what we call those work from home stocks. So companies such as Amazon, Netflix, Zoom Video, just to name a few, skyrocketed in asset price. So we've seen companies go up 100, 200, 300%, and what we call those work from home or those stay at home plays. Now, after a few months, something interesting started happening. Those stocks that had been growing tremendously because of the pandemic, those growth stocks, started not performing as well as other stocks. So if you look at the charts over the past 6 months, companies such as Apple, such as Amazon, such as Netflix are actually very, very flat, whereas other companies have now started increasing in price very much. And those are the reopening plays. And those are companies such as banks. So when we look at the stock of JP Morgan, it has been going up significantly. It's hotels, travel, hospitality. If you look at all of those stocks, those have been increasing at an incredible rate, quite similar to how those tech stocks or how those stay-at-home stocks were increasing. So what's actually happened over the past 15 months? Has all of a sudden these high-growth companies such as Amazon stopped growing, or is there something else to it? This brings us to the concept of stock market rotation. Say you as an individual investor have £100 to invest. What probably happened is at the beginning of the pandemic, when people started investing, it was around about March 2020, when we hit our record lows, people start putting money back into the stock market. So if you had £100, people invested that in those stay-at-home plays, those Amazons, those Zoom videos, because they expected that as you stayed at home, people would be using Zoom video in order to work with their companies. They would be buying online. And of course that happened. But once those companies increased to record levels, that's when we started having a discussion about the economy reopening. Now, it doesn't mean that Amazon stopped growing. It actually means that there's some certain companies that are potentially undervalued that we would want to buy into. But we only have £100, $100, so we can't buy more. So in order to buy those companies that are potentially undervalued, such as some hotel names, let's just say Marriott, we need to sell some of our Amazon shares in order to buy Marriott shares. And this is what we call a stock market rotation, when investors sell into some of the existing high performance assets in order to buy assets that they deem to be underperforming. This is a typical example of what is happening right now, and there's a bigger debate taking place with regards to interest rates and inflation. But putting it very simply, at the core of the current market performance for individual stocks is this stock market rotation from stay-at-home plays to reopening plays, which is very, very interesting. So now that we've talked a little bit around the three types of stocks, growth, value, and income, and we can see that at the start of the pandemic, those growth stocks outperformed the broader market because we were having that stay-at-home play. Now that we have the reopening play, we see some of those value stocks going back up to levels that we saw previously. So where do I want to invest at the moment? What are the three stocks that I potentially want to buy right now? So in order to pick stocks, we're looking at the overall economy. What is my assessment? My personal assessment, not as a financial advisor, but just my personal assessment. We see that yes, there is a reopening play taking place, and there are companies that are significantly undervalued because of that dip that they had at the beginning of the pandemic, and those stocks should outperform. But when we look at the long term, I'm confident that growth stocks will keep going up because they have that growth. So the reality is, my strategy is to make sure that I have a good diversification between what I would call growth and value stocks, because yes, in the short term, value stocks will go back up to what we would call fair value, so they have a little bit of room to grow. But at the end of the day, once those value stocks go back up to what we would anticipate to be the normal levels, investors will then want to rotate back into stocks that are exciting and are growing. So yes, in the short term, there will be in a little bit of an imbalance with value stocks outperforming, but in the long term, growth stocks should go back to outperforming. And that's why I want to position my portfolio, these three stocks, to benefit from these dynamics. So what are the stocks that I want to buy? So I'm going to provide stocks that are for the long term. And the first stock that I want to talk about is Disney. Now, I absolutely love Disney as a stock. It is spectacular in my point of view right now. And Disney is exciting for a multitude of reasons, because it is actually a growth stock, a value stock, and an income stock all in one. So let's make it very simple. Disney has two parts of the business right now. It has a growth element from Disney Plus, which is exciting. It is growing exponentially, and it has exceeded all expectations from when it was first introduced. And that is an additional income stream that is growing for Disney. So Disney has that growth component. At the same time, the majority of Disney's business is based on its parks, it's based on its hotels, and of its generally that travel cinema business that people aren't able to do. But now that the economy is reopening, that value part of the business that has been hit will start doing very well. People will start going to the cinema to watch Marvel films. People will start going to Disneyland parks, and we've already seen attendance and bookings to be very high. And that part of the business of Disney will recover. So we see that Disney has the growth part with Disney Plus, and it has the value part with the parks and the hotels and the cinema that has been underperforming. At the same time, Disney pays a very decent dividend. So for me right now, yes, Disney has increased significantly over the past 12 months, but I still think that Disney is at the perfect time of its business, that it has room to grow, and it will be a great long-term pick. Now, the second stock I want to talk about, which I think is an exciting play, is a growth play, and that is Crowdstrike. Now, recently we've seen a couple of things taking place in the world economy. We've seen an increase of stay-at-home and digital companies overall. So apart from just a stay-at-home play, we've seen a record amount of adoption of digital collaboration tools from companies, whether it's Microsoft Teams, Zoom, or Slack. We've seen companies such as Salesforce report record revenues, because the fact is that companies around the world are investing in digital. At the same time, digital transformation is not just about how companies collaborate internally, but it's how they operate. We see a record amount of companies looking at autonomous driving, machine learning, AI, and generally connecting the business digitally either to the customers or internally. Now, I won't go into too many details, but there's also the added element of retail investors and cryptocurrencies, which is obviously a digital framework. Again, all of this means that the digital presence, all of the stay at home, this is why we have naturally seen companies that are in that space grow. Now, Crowdstrike for me is a great name to own right now for two key reasons. Firstly, it's a digital security company, and we have seen recently more and more cyber attacks take place. More and more there is an increased need for both governments, companies and individuals to ensure that they are safe digitally and be able to protect against these digital cyber attacks. So Crowdstrike is operating in a very high growth industry, and that is evidenced by the growth rate. So we see year over year the growth rates for Crowdstrike to be very high. Now, at the same time, and this is the second element of why I think Crowdstrike is a good buy, is that they have a competitive product. So when we look at the Crowdstrike business compared to the other companies in which they operate in, it is generally very well accepted that Crowdstrike has one of, if not the best product and a significant competitive advantage right now. Now, again, there's a lot of companies that you could potentially invest in this space, and I think there are other names that are very nice. I personally own Crowdstrike shares and I like them very much. And I think that yes, they do right now command a high price to earnings ratio, but I still think that because of the company's growth and because of the overall environment of cybersecurity that is growing, Crowdstrike is a great company to potentially own right now. And because it is a growth stock, I also appreciate that there is a little bit more risk with it, but I'm also happy to take that risk at the moment. So the third and final company I want to talk about potentially investing in is actually solar energy, and that is Enphase. Let's take a little bit of a step back. So I talked to you a little bit about stock market rotations, and we talked about going into those value plays. And energy is a big value play right now. So companies such as BP and Shell have seen the stocks recover gradually, and they pay a great dividend. So companies such as BP would potentially be a great reopening play, and I actually own BP shares, and I think they will continue to grow, they will do very well, and they will also have a very strong dividend. So that is a potentially good play. But I'm more excited about companies such as Enphase, which are not only an energy play, but also a long-term energy play. So when we look at the Biden administration's agenda on infrastructure and clean energy, there is a very big appetite towards solar energy. And even if we step away from the US politics, you look at multiple businesses and business owners giving a clear signal, just as Elon Musk, that solar is the way to go forward. In fact, the business results substantiate that. Many solar companies such as First Solar and Enphase are generating very high revenue growth, not just in the US, but in other parts of the world such as Europe. So I'm a firm believer that in the long term, yes, we will still have oil. I don't think that's going to disappear. But when we look at the next couple of years, I feel that there's going to be a significant push towards clean, renewable energy sources. And I think solar is going to be one of the big winners in that space. So why am I picking Enphase? And this is back to my basic principles of understanding the business you're buying in. So and again, I'm not an expert in solar energy, so I do understand that there are things that I will not understand. And if anyone is an expert, please share your thoughts in the comment section below. But when you buy solar energy, there's two things to potentially buy. One is the panel, so panel manufacturers such as First Solar. And the other is the microconverter that converts the sun power to actually energy that you can use in your house. When I look at the overall market, there's actually quite a few competitors with regards to solar panels. And as I said previously, I'm not an expert in solar technology, so there's quite a few players and I'm not too sure who's the best one, and I don't have the expertise to judge. But when I look at the microconverters, there's only two main players, which is SolarEdge and Enphase. Just by looking at the management of the company, as I've said in my previous videos, that looking at the management of a company is really important, and looking at the competitive product and the company health, I made a decision recently to buy some Enphase stocks because I think it's a very high growing company. The management has showcased the ability to turn around the business over the past 10 years. So if you don't know about Enphase, check out their history. They have quite an exciting history where they nearly went essentially bankrupt, and the management has been able to turn that around. So they have a very competitive product with very few direct competitors in what is potentially a very profitable and high growing market in the future. And therefore, it is my third stock that I'm buying for the rest of the year and as a long-term investment. So these are the three companies that I have bought, and I'm looking forward to see them grow over the long term. Now I would expect to keep these stocks at least for 5 years. And as I said, the first one is Disney, a great mix of an income, value and growth stock in one. Crowdstrike, a very exciting company in an environment which is conducive to its long-term growth. And of course, Enphase, which is a company that provides microconverters for solar panels. Again, a firm believer that clean energy is here to stay. As I've said in my previous videos, investing is all about investing for the long term and picking companies in which you understand the business, have an ability to research them and make an educated investment. Now, as always, the best way to make long-term gains is to invest, dollar cost average invest in an index fund such as the Vanguard Index Fund, but I also like to allocate a very big part of my portfolio, around about 30 to 40%, to individual stock picking. Hope you've enjoyed the video. As always, please like and subscribe and also leave a comment in the comment section sharing your thoughts. Thank you for watching and I hope to see you in my next one.